Hi and welcome. In this series, we are breaking down how the American credit system actually works in simple, practical terms. No complicated language, no confusion. Just clear explanations you can actually use. And today, we are starting with the foundation what a credit score really is and why it matters so much. Most people think a credit score shows how rich you are, but it doesn't. It shows how safe you are to lend money to. And that one number can decide if you get approved for a credit card, a car loan, a mortgage, or even an apartment. So let's break it down in simple terms. A credit score is a three-digit number, usually between 300 and 850. The higher the number, the more trustworthy you look to financial institutions. But here's the important part. It's not about how much you earn. It's not about how much money is in your bank account. You could earn $100,000 a year and still have a poor credit score if you don't manage your debt properly. It's about behavior. Do you borrow responsibly? Do you pay back on time? That's what the system checks. In the US, there are three main credit bureaus: Experian, Equifax, and TransUnion. These companies collect information about your loans, credit cards, and payment history. Then scoring models like FICO use that information to calculate your credit score. So when people say my FICO score dropped, they are actually talking about the number calculated using this data. Every payment you make, every balance you carry gets recorded. There are five main things that affect your credit score. First, payment history. This is the biggest factor. If you miss a credit card payment even by 30 days, your score can drop fast. Think of it like this. If your friend keeps returning money late, you stop trusting them. Banks think the same way. Second, credit usage. It means how much of your credit limit you are using. If your credit card limit is $100,000 and you are using $900, that's 90%. That makes you look risky. A good rule, stay under 30%, so under $300 in that example. Third, length of credit history. If you have had a credit card for more than 8 years, it looks more stable than someone who just got a card a month ago. Time builds trust. If you apply for 4 credit cards in 1 week, it make you look like you need money urgently. That can lower your credit score temporarily. And fifth, credit mix. Having different types of credit, like a credit card and an auto loan, can actually help your profile look balanced. Your credit score affects your interest rate. For example, on a car loan, a higher score could save you thousands of dollars over time. But a low score means you pay more for the same car. So this number may look small, but it controls big financial decisions. If you want to improve your credit score, pay on time every time. Keep your credit usage low. Don't close old accounts unnecessarily. Avoid applying for too many loans at once. And remember, credit is built slowly. There is no shortcut. Your credit score is your financial reputation. It takes time to build, but it can drop quickly. In the next episode, we will talk about credit lines, what they actually are, how they work, and how people misuse them without realizing it. Because once you understand how credit lines work, you start using credit strategically instead of emotionally. Thank you.